Did you know that some people put more cash down on a home than they need to when they could have had a better return on their investment elsewhere? Hi, this is Landon Maxfield with the Maxfield and Associates team at Coldwell Banker Residential Brokerage. Your ability to afford a home will be related to a number of items, and those items include the price of the home, the down payment on your home and thus the amount financed, the interest rate and points of your loan, or in more simple terms, the amount the bank charges you for the money, the term of your loan, whether you do a 10-year, 15, or 30-year loan, the overall type of the loan as well. So most common types would be a fixed rate loan, but there are variable rate loans that are out there, which actually creates literally hundreds of different types of loan packages from which to choose from. And just in case you're looking for a specific rule of thumb for financing your home, other than some of the debt to income ratio and things like that, there really aren't general rules of thumb about financing, simply because each individual case is different and your personal financial circumstances will have an impact on how much you can afford overall. However, you must learn about and come to understand the relationship and impact that interest rates, the term of the loan, the cost of points, and the type of loan can have on your specific overall financial picture. So I want to take a moment to break down these relationships and impacts that they have on one another. So let's start with the amount financed first. There are people who pay cash or put 20% down or more as equity on a home. Now, the reasons that they do this vary and are several. Some do it because the bank required them to. They've always just put down that amount, or even better, they wanted a lower payment. Now, the problem with these reasons could cost you thousands of dollars. The answer for how much you should put down on your home is different for most people. However, one thing that we have learned over time and through experience is that a good portion of people put down more cash on their home than they need to, and could have received a better return on investment had they invested the money instead of putting it into their home. Here's a simple and fast way to ballpark the actual annual return on investment that you get from your money when you put down on your home. The first step is to take a look at the homes in your area of interest. How much have they appreciated each year on average over the past 5 years? So for example, you might find that the values have increased on average of 1.5% a year in that particular area. The second step is to take the total cost of your prospective home and multiply that value by that annual appreciation rate, in this example, 1.5%. So if you have a $150,000 home increasing at 1.5% for the first year, it'll be worth about $2,250 more a year from now. Now, the third step is to divide the amount of that increase in the home, so in this example, $2,250, by the total amount of down payment you put in the home. So let's say, for example, you're considering putting down 20% or $30,000. So divide the $2,250 into the $30,000, and the end result will be about 7.5%. Now, 7.5% sounds like a fair investment, but the question you need to ask is this: can you make more than 7.5% elsewhere? And did you notice something else here? Had you put down just $15,000, your return on your down payment would actually be 15%. So the moral of the story here is putting more money into your home may make your banker happy because it lowers the risk of them getting their money out in case you default. And it may make your overall payment a little lower, but it may be a wiser decision to put less into your home if you can locate an alternate investment that will pay a greater rate of return on your hard-earned equity. Also keep in mind that as you lower the amount that you put down on a home, a mortgage lender's requirement to pay mortgage insurance might come into play. So I recommend shopping around to see what financing options are available through a variety of lenders in minimizing or even eliminating mortgage insurance costs. Now let's shift gears a little and prepare you for what's coming in our next video. We're going to talk about how the impact of the term and the interest rate of your loan will have on your overall financial picture. The combination of the interest rate and the term of the loan you choose can make or cost you tens of thousands of dollars. So prepare for this next video. For more information on today's topic or other aspects of buying a home, visit us on our website at servingutah.com or give us a call today. Until next time, I'm Landon Maxfield with the Maxfield and Associates team, helping you make the right move in real estate.